Every dollar in your bank account feels real, tangible, safe. But most of the money you see in your account never truly existed. The bank holding your deposits can create new money out of thin air and do it entirely legally. You deposit $1,000 today. Tomorrow, that same $1,000 can fund a $900 loan to someone else while still counting as fully yours. That's not a mistake. That's the system. By the end of this video, you'll discover how ordinary deposits fuel extraordinary power for banks, why this system is both fragile and unstoppable, and how it's shaping your financial future in ways most people never suspect. To understand how banks can create money from your deposits, we need to go back centuries. Money wasn't always paper notes or digital balances. Ancient civilizations used commodities, grain, cattle, and shells, as a medium of exchange. Wealth was about trust. Merchants and rulers issued promises, promissory notes, IOUs, letters of credit, which allowed commerce to grow beyond physical constraints. In medieval Europe, goldsmiths offered safekeeping for precious metals. Citizens deposited coins and received receipts. Few withdrew all their gold at once. Goldsmiths realized they could lend portions of the gold while honoring depositors' claims. This is the foundation of fractional reserve banking. A promise to pay became a tool to multiply money. In 1694, the Bank of England formalized this system. William Paterson pioneered methods to issue more credit than gold reserves allowed. John Law in France linked money to public debt, creating vast new credit and the first bubbles of modern finance. Modern banks don't just hold your money. They leverage it to create more money, invisibly, legally, and at enormous scale. A bank deposit isn't money in a vault. It's an accounting entry. If you deposit $1,000, banks keep only a fraction, say 10%, as reserves. That's $100. The remaining $900 can be lent to someone else. That borrower deposits the $900, which can then be lent again, multiplying money across the system. Over several iterations, $1,000 can create tens of thousands of dollars of new money. This process is legal and endorsed by governments. Banks profit from money they technically don't own, compounded by interest from borrowers. Every mortgage, car loan, and business loan is part of this invisible money expansion. Most depositors never realize how much of their money is imagined by the banking system. Digital banking multiplies this effect even faster. Transfers don't move cash. They change ledger entries, creating more money instantly. Several figures shaped this system. William Paterson, founder of the Bank of England, innovated ways to lend beyond gold reserves. John Law, French economist, issued paper money backed by government debt, creating massive credit expansion and eventual collapse. Mayer Amschel Rothschild, 18th century financier, built an international banking model leveraging credit, debt, and secrecy. They understood a secret ordinary citizens did not. Money is power. Control over credit equals control over economies, nations, and wars. By the 20th century, central banks institutionalized fractional reserve banking worldwide. The Federal Reserve Act of 1913 gave U.S. banks the legal authority to multiply deposits via loans, fueling industrial growth but making the system fragile. Fractional reserve banking became the backbone of modern economies. Banks weren't just storing wealth, they were creating it. Entire industries, cities, and nations thrived on credit expansion. In 1920s U.S., banks fueled consumerism and real estate speculation. Post-World War II, bank credit enabled suburbanization and corporate growth. But the system depends on trust. If depositors demand too much cash simultaneously, banks can't deliver, a bank run. Yet the system persisted. Every crisis was met with stronger central banking controls, bailouts, and regulatory adjustments. But the ability to create money from deposits remained. Today, the scale is staggering. Global debt exceeds $300 trillion, nearly 4 times global GDP. Much of this exists because banks can lend money they technically don't have. Digital banking multiplies credit instantaneously. Even with cryptocurrencies, most global transactions still feed the fractional reserve system. History repeats, crises emerge, governments rescue banks, money supply expands, and ordinary savers remain unaware. The rules haven't changed since medieval goldsmiths. They've only become more complex. Attempts to reform the system have failed. Full reserve banking, requiring banks to keep 100% of deposits, was rejected in Switzerland, 2018. Dodd-Frank Act 2010 regulated risk but did not stop banks from creating money. Modern economies depend on credit expansion. Restricting banks threatens growth, increases unemployment, and risks recession. The cycle continues. Banks create money, profit, and governments rescue them when crises strike. Trust in money shapes society. Fractional reserve banking creates wealth for a few and risk for many. Ordinary citizens save diligently, unaware their deposits fuel bank profits. Inflation erodes purchasing power subtly. During crises, the public suffers while banks are reinforced. The system appears stable but thrives on hidden fragility. Money is mostly an illusion of credit. Deposits are multiplied across the economy. Banks profit from your trust. Your savings indirectly generate wealth for them. Crises are inherent. The system that allows expansion also ensures instability. Next financial collapse could strike at any time. Understanding money creation is the first step toward financial awareness and security. Banks legally create money from your deposits without you noticing. It's a hidden engine fueling centuries of economic growth and crises. Like, subscribe, and share to uncover more hidden financial truths. In a world where money is largely imaginary, knowledge is your most tangible asset.